On today's show, we will focus on inflation and the Fed. Wharton finance professor Nick Roussanov joins us in a bit to discuss the latest inflation data off of the CPI and PPI reports the last 2 days, as well as what the thinking of leaders of the Federal Reserve currently is and what their path is around rate cuts or maybe even rate increases. Then we'll be joined by Wharton legal studies and business ethics professor Peter Conti-Brown to look at what the Fed has done in the last couple of years to manage inflation and how this path compares with other times in our country's history, as well as how the Fed reacted back then. Well, we mentioned moments ago the data that has come out in the last 2 days around inflation. Looking at the numbers, they would show some heating up, but the question we ask is this the beginning of a path where there might be higher levels of concern, or is this just a blip on the radar? Pleasure to be joined right now by Wharton finance professor Nick Roussanov to break down the data. Nick, great to talk to you again. How are you?
I'm well, Dan. I'm great. As always, happy to be here.
Thank you, sir. All right, so let's dig into the data that we've got in the last 2 days and give us your read on what it tells you about where inflation is at the moment.
Right. So markets were jostled a bit yesterday by the news of the CPI report that came in higher than expected, and in particular, core inflation. CPI, excluding food and energy, came in quite a bit higher than expected at about 3.3% year on year. But that even masks a little bit the fact that there was actually an increase the monthly rate to a highest level that we've seen since April of 2023. And so what happens pretty much every time that there's a kind of positive surprise, positive as in higher than expected reading in the core CPI, the markets sell off across the board. So equities down, bonds and dollar up as other currencies slide, with the kind of expectation that, well, the Fed will pause the rate cuts even longer than perhaps was anticipated. Now, if we dig into the numbers a bit, what was driving it? Is it really seasonal? Some bits might suggest so, that the transportation services were a big contributor, but also shelter. Shelter has been going up in recent months. And that is, I think, again, concerning for Powell and the Fed and for all of us, consumers. Now, it's too early to tell whether this is going to really lead to a new pickup in inflation, but certainly is not helping bring it down, right? So even if we look at kind of year-on-year inflation numbers slowly grinding down, this tick up is not kind of going in the right direction. And in fact, if we look at specific kind of measures of inflation that emphasize stickiness versus kind of how quickly prices change. So Atlanta Fed puts out numbers for a sticky CPI as well as a flexible CPI. The sticky CPI, of course, has been sticky, meaning going down particularly slowly. But this month it had picked up in January. So it does not bode well for the Fed reaching its target of 2% inflation. Now, the Fed looks at the PCE, Personal Consumption Expenditure Index, which is a bit different from the CPI, and that will probably come in a bit lower, somewhere in between 2 and 3, probably 2.4, 2.5. And I think that's some commentators feel like that's going to give the Fed enough cover to continue easing maybe sometime in the fall. But it's too early to see. And today we've had another reading from the Producer Price Index, which also surprised to the upside at 3.5% year on year. But nevertheless, the market seems to be shrugging it off. In fact, there's kind of a recovery across the board, perhaps because the surprise was not as big in relative terms. Of course, PPI is more volatile than the CPI, and kind of parsing these numbers has led many observers to conclude that, well, the PCE reading will not be that bad.
Right.
And again, the PCE is what the Fed ostensibly really cares about most.
So what's interesting is that when you look at this at the ground level a lot, you see a lot of the commentary about how good the economy is right now. But then you also talk to people who say it's really challenging when you're thinking about the prices of food when they go to the grocery store. Obviously, gasoline has been up and down, and some of the other factors in play. You mentioned obviously housing and some of the components around there. So it's a dynamic that's very much, kind of one playing off against the other in terms of how much impact we are seeing in these different areas right now.
Absolutely. And if we look at the kind of the readings of the real economy that the Fed really pays attention to, primarily employment. Again, it is full employment that is in the Fed's mandate, along with price stability. The unemployment has been healthy. We've been around 4.1 since the fall, and again, today's reading of the initial unemployment claims came in a bit lower than previous week. And it's been going up and down the last few months, but nothing indicating any sort of serious weakness in the labor market. Unlike a bit of a scare that we had in the fall, August, September, when it looked like employment was softening, and maybe Fed was not cutting fast enough. That was the talk of the town then. Not anymore. It looks like
Right.
employment situation is healthy. Now, the different side of it, of course, is that the real incomes of many Americans have not caught up yet with the inflation that we've had over the last basically 4 post-COVID years.
Right.
So it's not surprising that people feel like the economy is not as good as they had hoped, because if your income has not gone up with one for one with inflation, then you feel like you're falling behind. You may still have the job,
Yeah.
but it's not the same. It's not the same feeling having the job that pays well, and having the job that pays maybe just enough to scrape by, which is, I guess, what a lot of consumers are feeling.
What do you think then this means for the mindset of the Fed when they're thinking about potential rate cuts? And I guess to a degree, do we even have to start throwing in the component of a potential rate increase here at some point? And I say that because, former Fed Vice Chair Roger Ferguson did an interview earlier today where he even hinted at that as something that at least you have to keep on the radar, especially if this path of inflation continues to stay in this same manner.
So if today turns out to be not just a blip, meaning today, I mean the last kind of 3 days, 2 days of CPI and PPI readings, and in fact proves to be a kind of a resumption of an upward trend in inflation, uh, that is certainly within the realm of possibility. The problem is the Fed is facing a very kind of delicate balance here. They would like to keep employment or unemployment roughly at where it is now, while bringing inflation down. If they have to resume rate hikes to combat rising inflation, if it picks up again, that of course is going to do some damage to employment. That's not a big surprise, and I feel like it's highly unlikely that they will really go that route unless inflation really accelerates in the coming months. And there's a lot of unknowns there, as Chairman Powell made clear. There's uncertainty about tariffs. There's uncertainty about tax cuts and deficits. All of those will weigh on consumers and investors and firms' expectations.
Right.
Firms are already raising prices just based on kind of the expectation of tariffs. And of course, some of the announced tariffs. So metals futures prices are up between 5 and 7% since kind of the talk of the tariffs on steel and aluminum. And of course, that is going to reverberate throughout the economy. The construction sector is going to be affected. Shelter is not going to become cheaper if construction is going to get more expensive. So there is quite a bit of uncertainty of how much policy is going to contribute to the inflationary pressures. That's
Right.
what That's what I think Powell and the rest of FOMC are worried about. It's not necessarily clear that the rate hikes that would put additional pressure on the real sector would do enough to undo any potential damage from uh, pro-inflationary policies.
Nick, great to talk to you today. Thanks very much for your time and your insight. All the best.
Thank you too, Dan.
You got it. Nick Roussanov, finance professor here at the Wharton School. Well, as we have been mentioning, the last few years is very unique when you think about fiscal policy. The country obviously going through an unprecedented period with little to no inflation, only to see the impact from the pandemic send the country back to levels of inflation not seen in several decades. Peter Conti-Brown is a professor of legal studies and business ethics here at the Wharton School. He's also author of the book, The Power and Independence of the Federal Reserve. Great to see you again, my friend. It's been a while. Pleasure to chat.
So good to be here with you, Dan.
Thank you. All right, so before we dig into the history side of this, I wanted to kind of get your thoughts on what we have seen from the Fed over the last several years in terms of how they are kind of having to move and duck and dive because of all these dynamics at play.
Yeah, I think ducking and diving is a good description. I think that the Fed went through a rather searing episode in kind of the post-crisis era. And that is, we had interest rates just stuck at the zero lower bound from November 2008 through December 2015. And yet we just didn't get the bounce back, the post-recession bounce back to full employment. It was just agonizingly slow. Yeah. So unemployment rates at a very high level, at the 9%, 8%, 7%, 6%, just coming down just little by little. And those numbers, as opposed to full employment, being with an unemployment rate being around 4% or something like that, that means just millions of people demoralized, trying to get a job and failing. Yeah. And part of that is going to be structural. There are issues that in the economy that has nothing to do with the central bank. But part of that is a question that central bankers they engage in some soul searching, which is, what should we be doing? Fast forward March 2020. You remember that?
Oh, yeah.
Yeah.
Sticks in my memory for a long time.
For all of us. And it does for the Fed in a profound way. And the year 2020 was a period of extraordinary experimentation inside the Fed. They dusted off the 2008 playbook and added to it by just injecting so much monetary stimulus and liquidity and setting up emergency facilities. And here's what's important, working hand in glove with the first Trump administration and Congress to support a fiscal monetary response to the effectual closure of the global economy. And what's astonishing is just how successful that was. Yeah. So we had unemployment just go spike sky high, and then collapse. Yeah. So the employment rate reached full employment faster than anything we'd ever seen in history. And so when the Biden administration comes in, we had just stimulated the economy with unprecedented packages in the Trump administration, 2 of them, and Biden wants. The Biden administration wanted to do theirs too. 2 gigantic stimulus packages. And the Federal Reserve, which had been cheerleading the fiscal stimulus through 2020, now starts to see early signs. They're still kind of in that posture, and they're starting to see early signs. Wait, did we overdo it? Yeah. And so they find themselves, come 2022, a little bit flat-footed for the first time since the Volcker era. Ronald Reagan was president, first administration.
The transitory comment.
Yeah, this is where everybody was like, okay, here's inflation, and we think it is transitory. This is going to work itself out. And again, in hindsight, that looks obviously wrong, although I'll tell you, economists are still debating exactly what was the nature of this inflation. Yeah. It shot up, came back down, but is still with us. It's not reaching back down to that 2% target. Yeah. What does that mean for the Federal Reserve? It means that it's had to pivot and pivot again and try to be nimble and flexible. And when you have an administration, so here I'm talking about the president and Congress, the politicians who give the Fed its due and say, okay, we may not like this, or maybe we do, maybe we don't, but you have the space to be nimble, then the Fed feels so much more comfortable.
How do you look at this from a historical perspective? Because going back over, decade upon decade, I was looking at some of the numbers. We've obviously seen double-digit inflation before, but usually it's been tied to some big event like World War I, World War II to a degree. Then you had the 70s, and obviously there were some dynamics at play there that I think. But so how do you look at what the Fed has had to deal with in the scope of, from a historical perspective, what we've seen play out for many decades?
Well, the Fed is deeply invested in its history. I mean, think about a family reunion where you go to and your great aunt who always likes to tell the stories about like your grandparents or whatever, who like they have the family history there and they want to tell you about it. The Federal Reserve has its family history. And in this instance, Jay Powell and crew were laser focused on Paul Volcker, which is ironic because when Jay Powell first stepped in, he was thinking about different kinds of examples that the Fed had done too little during the Bernanke and Yellen era. And so now Powell wanted to do more. And then he flipped back thinking about it in a different way. The Federal Reserve went through an extraordinarily painful period, not just in the 70s, but 1965, roughly till 1984, where inflation was temperamental, sky high in the late 70s and early 80s. And very hard to calibrate monetary policy relative to the inflationary environment they were encountering. Now, that was a global phenomenon, and so there were some non-U.S. Contributors to it. Economic historians still argue about the extent to which oil shocks during the OPEC-led oil embargo in response to war in the Middle East and much else. We still argue about the contribution that those policies had, these so-called supply-side factors. But virtually everybody agrees that Federal Reserve policy during that period was just wrong.
How important then, as we move forward, and you wrote about this in your book, is the independence of the Fed in terms of trying to get inflation under control, in terms of having the mandates and having the paths that they need to go forward in?
Yeah. Let me give 2.5 cheers for Fed independence, not 3 cheers.
Okay.
And central bankers want us to give 3 cheers or 4 cheers or 5 cheers. Central bankers want to see their role as being entirely focused on the long-term health of the economy without any other kind of distraction. They have no other issues. We just heard from Powell this week where he really was just saying, how he doesn't use religious terminology, but it really does feel like a kind of priesthood that they're holding the sacred relics of the macroeconomy inside, their great temple. And I'm going to say that for the most part, they're right. That Fed independence is doing a thing. It's a political answer to a political problem, and that is that all politicians, not just Donald Trump, are going to be focused much more on the next election than they are on the state of the economy 10 years from now.
Right.
It's just the way that democratic procedures work. And Fed independence, such as it is, does a pretty good job of wresting the attention from politicians from the immediate term to that medium term. But it's got a lot of problems with it. And the biggest problem of all is that central bankers are making value judgments about how to prioritize different aspects of their remit. The remit is written by politicians. Congress is their boss. All right, their central bankers themselves are appointed by politicians, picked by the president, confirmed by the Senate. But just because it suffers from what theorists like me call a democratic deficit, this is not a democratic institution.
Right.
That does make it imperfect.
Right.
The question we got to ask is, compared to what?
Yeah.
And if it's compared to central bankers who take an oath of loyalty to a person, right, as opposed to policies, then what we have right now is not just better than the alternative; it's much better. And in that sense, we'd want to preserve it. And that's the thing that I fear, and that's what I'll be watching most of all. Is in the current administration, it is just basic democratic theory that the Federal Reserve and every other organ of government should shift its policies in response to the election.
Sure, yeah.
To do otherwise is anti-democratic.
Yeah.
What we don't want to see is, even in response to that election, is for the central bankers to give up on the law, give up on the traditions and the history in favor of what one person thinks is in that person's best interest, and even if that person happens to be the president.
Peter, great to see you. Thanks very much.
What a pleasure. Thank you, Dan.
Thank you. Peter Conti-Brown from here at the Wharton School. Well, that does it for our inaugural voyage on Wharton Business Today. I'm Dan Loney. Please join us again for our next show. And, of course, follow all of our content on our social channels as well as the Knowledge at Wharton website.